just business news, we're news for business people.
Well, this is third quarter earnings with Bloomberg Quint and Capital First. Strong quarter, profits and net interest income both have seen a substantial jump. Joining us to talk about the quarter gone by and the outlook ahead is Mr. V. Vaidyanathan, CMD at Capital First. Mr. Vaidyanathan, thank you so much for taking the time out and joining us.
Thank you.
It's been across parameters, I would say, it's been a strong quarter. Would it partially also be aided by the fact that there was a low base the last quarter? And part two of my question would be, if this is what you've done in the O&D quarter, is this a sign of things to come for the next few quarters as well until the merger happens?
It's not really on a lower base or higher base actually. If you take a CAGR of Capital First of 5 years at a stretch, it is a CAGR growth top line of 27% of AUM and profit growth of 40%. So I think it's been a steady story coming from since the last 5 years. In our case, frankly, it's a pretty straight business. You know, you grow the loan book, you get the more NII. As long as the quality is good and credit losses are under control, the profit continues to grow. And that's what's happening at Capital First.
Yeah, but if the reason why I ask this, because across all parameters, both the AUM growth as well as the profitability, the numbers, good as they are better than what the best of the estimates were on the street. So did a base factor also help you, or is this pure business momentum that could last into the quarters ahead, is my question.
A very good question, actually. See, we always guide for 25% growth for the last many years. It's 30% this year. So I think definitely for this year, ending into March, we are expecting to close at 27,000 crores, which would be anywhere about 30 to 35% over a starting base of 20,000 crores of last financial year. So I say this year looks pretty much safe and in the bag. For the next year, probably we'll guide for 25% again.
Okay.
It's too early, I know, to ask you about, if you've started thinking deeper with respect to the strategy for the bank, and we just spoke about 10 days back, but just wanted one clarification. Post the merger, the share of Warburg Pincus will go slightly above 10%, if I'm correct, and if that's the case, they'll have to bring it down, just below that 10% mark. So have you heard from them on what their strategy is with respect to their investment in Capital First?
That's correct, actually. About 10.2 or 10.3% would be their share. On the other hand, IDFC is holding an IDFC Bank, so I would actually be a little short of 40%, probably close to 37%. So they will anyway need to buy, because I don't think they're applying for a dispensation from what I hear from them. So I think one has to sell and one has to buy, and I think there is still probably be a shortfall for IDFC in the whole equation. So that's how the equation will play out.
Okay, then we'll talk about Capital First, third quarter numbers only then. Okay, the third quarter numbers definitely increase some confidence that GST on SME and MSME, the impact has definitely diminished. So just wanted to understand if you believe there are absolutely no concerns on asset quality and gross NPAs, you think going into the next few quarters at least will remain between the 1.5% to 2% band itself?
You're absolutely right. Actually, when the GST when the demonetization happened in November of 2016, in the next quarter, we saw the gross NPA and net NPA for Capital First slightly going up by 20 basis points. It had moved up from 1.53% to 1.73%. Over the last 4 quarters after demon, it's come back to where it began. So basically, we can safely say that the impact that happened in the marketplace is fully neutralized, both on the gross front and the net front. Now, our reading from the market and by talking to entrepreneurs is that broadly things have settled, and therefore we don't expect any negative movement in our NPA numbers from here on.
So, okay, I have a two-part question to this. One is, if I look at how your margins have done, they've done remarkably well. And your high-yielding loans, if I'm not wrong, continue to rise, both two-wheelers, consumer durables. Is this setting the base for an already impressive set of margin numbers to expand meaningfully over the course of the next 12 to 18 odd months?
We don't guide for any further increase of margins from here.
Fair call.
The reason being that you can see that the bond yields have also been inching up, so it won't be very appropriate to guide for any improvement from here. But I'd say that we are quite comfortable to say that the NIMs will be maintained for sure. There's an upward bias to the NIM, if anything, but certainly there is no downside risk to it. We don't see it.
Okay, so I have one more question. I mean, and I think there's a classic debate, though. Managements have by and large said that there is an increase in the cost of funds. I think the debate that came about was that when you look at the yield curves, the long end of the yield curve has certainly moved up, not so much for the short end, and therefore the increase in cost of funds for NBFCs by and large will not be as steep as maybe the market is pricing it to be. How would you think of this over the course of the next 12 to 18 months? Again?
I will tell you our practical numbers if that helps you understand this equation better.
Yes.
Actually, typically what has happened is that in the last 3 months, I think the bond yields have hardened by anywhere between about 60 basis points or so. But what's happened is that the margin at which you borrow above the G-Sec actually has come down. So therefore, the increase in 60 to 70 basis points of yield from say 660 to 7.3 has not directly got translated to the borrowing cost.
Okay.
So that's one important factor to note. The second factor to note is that the bonds are not the only source of borrowing. There's a significant part of the borrowing, and it only affects incremental borrowing. The whole stock in our case are 20,000 crores. That's not getting repriced. These are fixed bonds. So the blended impact of this bond increases could be about say 10 basis points or so. And for our business sorts, 10 basis points is neither here nor there. So I actually take pains to clarify to people that nobody should worry about bond yields going. It's not the cost of funds gone by 60 basis points. It's only incremental. And it's a lender's business. For lender's business, sometimes costs will go up, sometimes they'll come down. It's our job to keep aligning our lending rates.
Sure. Yesterday, of course, government announced when they announced the recap plan for banks, they've also asked them to push lending towards SMEs. And of course, PSU banks have that capital to lend now, which they didn't so far. So is this a risk to SME-focused NBFCs like yours? There'll definitely be some, if not market share loss, but there's definitely going to be some tougher competition as far as maintaining market share is concerned.
Well, I can say this quite sincerely, actually, not just for your channels, that that the arrival of more state-owned banks and more players in the small and medium enterprise segment is actually great for India and great for all players. Because you really never want to be the big player in town and nobody else being there. Because if the state-owned banks were not lending to the state-owned to that small and medium enterprise sector, now it would be pretty difficult, so to say, for existing players to even refinance a particular loan, for example. You don't want to be the only lender to a customer. So actually more players coming in, the market expands. We really are looking forward to it. Actually, when the news came, not just yesterday, the first time when they announced the 2.11 lakh, there was a yippee kind of a feeling, fine, they're back in the market and stuff. So actually it's good for India, I can tell you.
Good for India, but will it only increase the competitive intensity? Because so far they were not.
No, you're making a good point.
Lending.
You're making a good point. I'm happy you're asking this. I'm saying when the pie grows, it is really good for existing players and particularly good for nimble players. So, for example, the US economy over the last maybe 30 years, as if there's moved from, say, being a 10 trillion economy to a 16 trillion economy, every player there has benefited. So I would say, therefore, that if the pie grows, it is really good. If you see the extent of SME lending in the sector, it's not more than 16% of the banking system's credit. It's really low. At some stage, it has to grow up.
Actually, so coming on that, Mr. Vaidyanathan, do you reckon that PSU banks, which are arguably not as nimble as NBFCs in this pocket, NBFCs like you, Bajaj Finance and the others, they're not as nimble. Do you think now with this push stroke capital availability to actually do that piece in the MSME space, they'll be able to actually create the market that they hitherto have vacated in large portions?
It depends a lot on the skill set, actually, more than the availability of funds. But certainly, this gives them more muscle. It gives them more ability to be more active in the space. And certainly being crippled with capital does not give them the feeling that they want to lend. I think just the tonality will change.
Sure.
I am almost seeing every chairman or every managing director of every large bank, state-owned bank now talking that we want to grow SME. And that's uniformly 10 on 10 talk this language. So I think that's really good news. And by the way, let me not say that all state-owned banks, let us not say that all state-owned banks are not nimble. For example, look at State Bank of India.
No, of course. I mean, they haven't vacated market share at all.
They're a league of their own. So
completely agree. Okay, I have answered my questions on all capital first quarters. If you have any, because I just wanted to ask a budget question as well, unless you have a capital first question. What do you expect this year's budget, both from a perspective of a retail-focused NBFC, as also from a perspective of a soon-to-be bank?
Well, actually, I say it's not just a expectation. Actually, I would put it as a wish that we make serious investments in agriculture, because I think that is one area that people are really worried about, and you can see the storylines coming there. Of late, I think that story is also improving because of two good monsoons and maybe some consumption push through Narega and all that. But fact is that is one big story. Second big story I'm really looking forward is infrastructure. Really, for the financial sector, it's nothing, there is no really demand list, wish list, nothing like that. I'd say if it's a pro-poor, pro-agriculture, pro-infrastructure budget, I'll be very happy. And that's what I actually expect. The election year coming up, I'd certainly expect that much.
Well, let's hope fiscal prudence also stays a part of it. But yeah, I think the point is well taken. Mr. Vaidyanathan, thank you so much for taking the time out and joining us
thank you very much.
On this third quarter interactions. Well, this was capital first and a strong quarter from Quess Corp as well, and the stock is in focus. It's been, as I said, a strong quarter. Joining us to talk about the quarter gone by, Subrata Kumar of Quess Corp and Yatin Mota from the research team also joining in. Yatin, over to you.
Thanks for that, Neeraj, and thank you, Mr. Nag, for joining in. Of course, congratulations first of all for a decent quarter. Now, if you talk about the overall earnings, can you tell us what kind of a business strategy is the company looking at, and what kind of a growth momentum do you expect moving forward as you take charge as a CEO?
No, there is no change in the overall strategy or the strategy, which is that expansion of our margin, increasing our overall revenue and profitability, and grow all the four sectors simultaneously will be the same strategy we'll be following up. So I don't see any major shift in the strategy in near future.
Okay. Also, Mr. Nag, talking about the inorganic growth strategy, you have done a new acquisition. If you could tell us what kind of synergies and opportunities does the acquisition bring in?
In India, the landscaping, I think, is a little bit of neglected area, and we see a lot of potential there with the growing of the economy and more, airports and everywhere. Our awareness of the greenery and with the smart cities. So this particular acquisition, though it's is at around 38 crore in revenue and it's a 12% margin business, but it will help us to get into this landscaping business, understand that business, and make a large landscaping company pan-India, I think next 2 to 3 years. So we'll be strive to do that, and in a short term it is a margin accretive. We are currently working around 6%. This is a 12% margin accretive, and it will also increase our bouquet in the facility management space. So I think it will help us in increasing our overall facility business as such.
Okay. Sir, shifting focus to the quarterly earnings, if you could tell us what were the growth drivers for the quarter gone by and what's the outlook moving forward?
Normally, quarter Q3 and Q4 are always good for us. P&S business, that people and services business, we have been growing strong. We are adding a lot of headcounts in the BFA side, in the consumer durables, where we are generally very strong. Our skill development business also seeing a lot of traction. We are opening more centers. So that business has been, as always, performing above the mark. And our margin also has been increasing. The other part actually in the facility management business with the addition of Manipal, we are in a strong foot on the many sectors in the facility management, particularly in healthcare and education. There's the two new sectors we got into. We are managing currently almost 20-25 large hospitals, 16,000 beds, few large format universities, and that has helped us increasing the overall margin in the facility management business. And with the addition of the TBSS, which is now known as the Connect Business Solutions in the customer lifecycle management, that helped us in our GTS business, Global Technology business, and I expect more to come there in the next few quarters. Industrial, though the margin, there has been a dip in the margin, but with the Vedang coming into our fold, we are very strongly poised in the telecom, in the both active and passive, infrastructure in the telecom space. So overall, it's a good quarter, but mainly driven by the people and services business and the facilities management business.
Okay, but specifically, sir, talking about your people and services segment, which is almost 50% of your revenue, there we have seen some margin pressure. In fact, the growth has not been that great. So, in terms of the margin trend, do you think that this trend is here to stay and probably margins will remain in this tight range?
I think you will be seeing a strong growth in this quarters. We have actually, it will be in the month of Jan. We started a large assignment or contract with one of the major BFSI companies in India that will add a substantial number headcount into our overall PNS business. So Q4, I see a strong growth coming in the Q4. Overall, this is the business we started with organically, entirely built this business, and we have a very strong management team, pan-India network, and our recruitment engine. So though there is a lot of noise about that, the lack of job growth in the job, but we see a lot of traction in this field across many sectors, and I'm very bullish about PNS business for coming few quarters.
Okay, good to know that. And sir, one final question on your segment of Global Technology Solution. You have undertaken a significant amount of expansion there. Do you expect the strength to continue here?
Now the global technology sectors we have normally other than the IT staffing, the TBSS is a new addition. That customer lifecycle management, we have two in there. That margin also is a 6% plus margin. 27,000 headcount plus company is a very strong brand and strong customer base. So we started working with the management of this company, and I see we will be expanding the service offerings into that business, and with that service offerings and the strong sales growth what Quess always bring into an acquisition, I think that our customer lifecycle management will definitely have a much stronger growth in coming quarters.
Okay, so that was the management of Quess Corp, hopeful of a strong growth coming in for the next few quarters. But we also have the management of L&T Infotech. So let's catch up with Ridhima, who is with the management of L&T Infotech, MD and CEO Sanjay Jalona.
Q3, which is traditionally a weak quarter for the industry, we had a 8.5% quarter-on-quarter growth, which results into what you mentioned, close to 20% year-on-year growth. Mm-hmm. What's even more important is that we opened 17 more logos as well, new logos, and 4 of them out of those 17 are Fortune 500 customers across the verticals. Great. Our digital revenue, as we keep innovating along with customers and partners, has also gone up to being 1/3 of the revenue for the company. Margins overall, if you look at EBIT number, have also gone up by 40 basis points. All of this, and we have seen this kind of a growth, we've been talking about being at the leaders quadrant on the growth. All of this has come about because of the $300 million plus TCV of large deals we have done in the last 6 quarters. Mm-hmm. And some of them have already started giving revenue. Some of them will continue. We'll do some transitions and continue to go in the next few quarters as well. So pretty excited where we are.
So going forward, by at least the next quarter in the next fiscal, do you expect any more large deals, at least of the big ticket sizes that we've signed so far? Anything of that quantum coming, or would it be the smaller deals? How would the way going forward be like?
All kinds. So there are large deals that we are chasing as well. There are large accounts that we focus on because mining large accounts is very, very important for us as an organization. There are new accounts that are also driving up growth. We at the last month, at the end of last month, we had something like $800 million worth of pipeline, and there are many large deals in that as well.
So by how much would you expect this pipeline to grow, at least by the next fiscal? Where would we see that? And also, which sectors would then be in the key focus area? What kind of clients? Because we are seeing a lot of growth in retail and pharma. We are seeing a lot of growth in high tech. So how would the deal activity really look like then?
So if you look at us, we are differentiated in a sense that we focus on fewer things. Fewer verticals, fewer capabilities, fewer clients as well. And our focus on clients, verticals, and capabilities is what is driving our differentiation and helps us grow faster. We see a broad-based growth. We are very positive about high tech, which has grown very, very fast, as you would see. We are very positive about CPG. We are very positive about pharma. Manufacturing is doing well. So BFS has done extremely well for us. We are broad-based, very, very excited about all the verticals. And new accounts are also, as I said, 17 accounts, all dispersed across verticals, 4 Fortune 500 in 4 different verticals. So there are multiple growth engines that are working for us.
Mm-hmm. With the acquisition of Syncordis, which is a banking implementation services platform, what is the kind of growth that you're expecting in your BFS vertical? How would Syncordis really complement that growth?
Syncordis is a very small company. We got only $1.9 million in Q3 from there, but it was only for a month. Syncordis has grown last calendar year in a double digit. We see it growing in double digits in the next year as well. But the important part is such a small number. It will continue to add on to the growth, but it will not dramatically change the growth percentage for the BFS vertical.
Also, when we talk about the services that the company offers, there's a lot of activity happening in the artificial intelligence, analytics space. And you've talked about that for a while. You've said that this digital would be the focus of LTI. So going forward, would we see any inorganic growth in that space as well? Or would it be all organic and the company would continue to grow, this particular service offering?
Ridhima, I've been there for 2.5 years. We have done one of the most successful IPOs. We have, in the last 18 months, also acquired 2 companies. We acquired Augment IQ, which brought us high-end Hadoop, Spark, Kafka analytics capabilities. We did Syncordis, which gave us digital banking capabilities. So yes, you would expect us to continue that path of also continuing on investing on automation, analytics, digital IoT, cloud. And that will be through organic as well as inorganic.
When we talk about India, although growing at a steady rate, which segments do you exactly see the growth coming from in terms of the recent orders that you would have got from the country, or going forward, which sectors do really look attractive there?
In India?
Yes.
So in India, we focus on few things. We said we will focus on large programs, whether it's large analytics program like the one which we did with CBDT, or large ERP programs. We believe those are the programs where we as L&T Infotech, LTI, with our heritage, we would be able to bring value because we understand what is the entire supply chain and so on and so forth, what needs to be done there effectively. So our choices we have narrowed down to working with ministries and programs which are analytics and ERP in nature.
So one last question. So in terms of growth, the company has grown in double digits so far. Going forward, would you continue to see such a growth? And if yes, then what would be that ballpark number where you see yourself growing at?
We don't give guidance, but I have said 10% last year, mid-teens this year, excited about FY19 with the large deals we have announced.